Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:51 a.m. Central Time, and I'm recording this in preparation for the market day of September the 8th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So the markets have been shut down for the holiday, and we now resume. So things are always a little funky after coming back from a holiday period like this. So that should be a purpose for caution for you today. But one of the things to keep in mind is that where has the market gone so far? And we are well up in terms of the four broad market U.S. indices. We're up about 1.75%, really just about the same percent increase on all four of the U.S. indices: S&P, Dow, Russell, and Nasdaq. In terms of crude oil is down about 1.32%. You have euro up about 0.28%. Bonds down a little over 0.5%, and gold just below scratch. In terms of overseas action, now they've been back longer than we have. Obviously, China and so forth, they were open yesterday. China's up 2.91% for yesterday. Hong Kong up 3.28% in last night's overnight activity. Japan down 2.43%. Germany up 2.21%, and United Kingdom up 1.78%, about the same as U.S. markets. So some really big moves here. But you got to keep this in mind. These are pegged from their prior opens. And for example, with the S&P, this is compared to its futures market open from yesterday. The futures were open for a partial day yesterday. So these are not necessarily compared in any way to Friday's closes. So just kind of be aware this is a little bit of a shift from what we probably report most of the time. In terms of the macroeconomic reports, you also have a pretty big schedule for the day if you include everybody. But for the U.S., just some yellow reports: small business index, labor markets, consumer credit. Nothing really that should be market moving for the U.S. reports. In terms of our volatility conditions, we did have on Friday standard deviation moves put in by both the S&P and the Dow. And you can see, obviously, we've had quite a bit of standard deviation moves put in the last 2 weeks. Though some of the largest activity, those 3 standard deviation moves we were having, those have largely aged off. But we still have plenty of volatility in our recent history here. You see on the S&P, there have been 3 the 2 standard deviation moves in the last 2 trading weeks. IV percentiles 58, 50, 53, 68. So historically these are around average levels, but compared to what we've been used to prior to the last couple 3 weeks, these are much higher. Short-term VIX at 26.88, so it's still very elevated there. Skew 132.43, and that would be in pretty hot zone there, so that would be something of a warning. Though we're going to have to kind of reset and rebalance when all the market participants come back together today once the cash market opens. And those levels that we normally refer to, pivot levels, all those kinds of things, those are going to be somewhat shaky today because some traders will be using the Friday market activity, which was a partial day on the futures market, but no cash open. Some traders might be using Friday, so things could be a little sloppy today as everybody comes back and people start finding, where the real support and resistance might be. In terms of our regular daily report, not a lot of changes here from Friday. Still phase 2 trend breaking, still IBD status marketing correction with an accumulation distribution score in the S&P of a D, Nasdaq an E. GMI index remains a 0 out of 6. out of 6, and that author remains in cash. Primary market condition, actually I have neutral bull here with Friday's action for the first time in my memory. We actually fell to a strong bear market. So um, it continues to deteriorate when you look at these overall opinions about where the market structure is, and not just short term, but more the intermediate and long term profiles. In terms of decision point, and you see the different time frames here, lots of red arrows across all the different time frames, across all the markets. So structure has very much changed here in the last 3 weeks. Intermediate term market posture is bearish, and indeed, if you look at the individual scores here, 29.1, that drops below a 20, that goes into correction kind of zones. The Dow's 35.2, Nasdaq's holding up better, but it's still bearish, 46.4, and Russell also near that 20 zone, which would be a severe correction type of activity for the intermediate term market posture. Position sizing opinions, both of them still remain at 0. And actually, one of these probably should be a 50% based on volatility. The VIX has dropped below a 30, so but still very, very, very low in terms of position sizing opinions there. Hedge warning status remains a threshold level 3, which is a crash warning. That is a warning. That is a risk is there, and the conditions are present that significant downward pressure could potentialize, but that does not predict a degree of down move or that we're in any kind of bear market as of yet officially. We're getting really, really close to being able to say officially we're in an outright bear market. Right now we're in correction territory, and if you take the longest term perspective, you use weekly candles or you use monthly candles, you'd still call it a bull market, but all but the most long-term perspectives are really being called into question on that, and certainly any of the shorter time frames are calling this bearish biases. You can see from the volatility base, we've had several warnings for Friday's action. Market in decline, sharp increase warning. VIX is up over an 18. Distribution day count, of course, we are in market in correction, so that count is by definition high. VIX phase increasing, skew up over 130. We are with the New York Stock Exchange, new highs, new lows. Didn't go to warning status, but certainly very skewed with only 16 new highs against 223 new lows. On the intermarket risk aversion indicators, we are 4 out of 5 at risk on, so that has improved in recent days, but it's still, many of these are in a weekly position and could flag back off to risk off with any kind of real activity. Now, so far today, of course, we're showing significant bullish action coming into the cash open. We'll see how well that holds up the next day or two. So often you get these big rallies in bear market conditions, and then that just serves as entry points for the next leg down. So we'll have to wait and see if we can get any new highs and higher highs and higher lows, and when that starts to happen, then we'll start to take a little bit more confidence that the bulls can actually mount something more than an opportunity for the shorts to re-enter the market. Option income strategies, position opinion. VIX is outside the acceptable window, so not recommended to take new positions using option income strategies at this point, unless you are a very, very nimble and very experienced trader and being able to handle the increased potential for volatility and delta action that might come through the use of those strategies. Cover call strategies, not acceptable to initiate new positions. One of the key authors that I follow on that is has stopped initiating new positions outright, and so I thought that was of interest as well. Put selling, And the same thing with cover calls. If you're going to be super, super aggressive and want to take in some positions, that's probably the way to go. So aggressive traders might consider position size reduction, looking for the bottoming patterns in their favorite stocks in the position that they're willing to own. Consider scaling into positions. Consider using defined positions with spreads and the like to be able to start those positions. Our relative rotation graph, you can see as of Friday, pretty ugly, but there are some exceptions. FDN certainly looks pretty good, ITB and XLU, and that is FDN, of course, is the Internet Index. XLU, of course, is utilities, the spider sector specific, and then ITB, home construction. So there are perhaps some bright areas um, to consider. Now, XLU, got to keep in mind, interest rate sensitive, very interest rate sensitive. Utility companies usually have very high debt loads, so they're very sensitive to changes in the interest rate. And in the middle of this month, just next week actually, we'll likely have a decision come down from the Fed about interest rates, and that could make this XLU really move one way or the other. It could go either way based on what that decision is. So just kind of keep that in mind. And let's take a look at sector specific numbers from Friday. Obviously, it's just as red as can be at all time frames. You know, no ship was spared in that harbor. And then you can take a look at the percent changes. You know, it was just ugly everywhere. And also, you know, keep this in mind. It's not just one day, but look, 1 day, 5 day, 1 month, 3 month, even year to date. Only the consumer discretionary on the year to date is even positive. So this is not a market to sit there and feel too confident about initiating a lot of new positions and so forth. This is a market to be, number one rule, protect your capital. And when market conditions become better and more appropriate, then start to look to initiate new positions. But this is a sea of red here, and in terms of a bullish standpoint, this is not the market to be super aggressive by any means. And if you're a conservative trader, it is best to be mindful to protecting your trading capital first and foremost. Now, if you want to start taking bearish positions, just outright bearish positions, then rallies like today, you know, can certainly prove to be opportunities for initiation of those. So you can start to look for those bear flag chart patterns and things like that. And that's really seriously starting to become more and more of the flavor, instead of you know, looking for our safe entries for bull positions. It's really starting to become more of an opportunity to initiate bearish positions whenever you get a rally pattern. So that's if we continue to break down, especially if we get past the Fed, and the Fed influences the market in such a way that we start to call this an outright bear market, then we will start reporting on this from that standpoint in terms of what are the opportunities in terms of the most bearish sectors, as opposed to our usual bias towards reporting in what are the most bullish opportunities, what's holding up the best, and all these kinds of things. So that's probably enough for today. As always, if you find what we're doing here is helpful to your trading, retweeting us to your Twitter followers or your StockTwit followers, um, you know, liking us in the YouTube channel or subscribing to us in the YouTube channel, sending us feedback to our email address at support@falconglobaltraders.com. All those things are quite helpful. More information is available at this website. Disclaimers as always. Hit the pause button if you need more time to review this. And we'll look forward to seeing you back here tomorrow morning for the market preview before the cash open on Tuesday.